It's Wednesday the 20th, I'm FX Plu and this is CurrencyTransfer.com's market update. And the main headlines today are that the MPC may well outline policy for the rest of 2018, Draghi repeats his dovish message on monetary policy, and the trade war represents a double-edged sword for the dollar. So sterling fell to new 2018 lows yesterday. We saw cable touch 131.50 and against the euro we touched 113.65. There are many reasons why traders are leaving sterling, but Brexit is absolutely top of the pops and a big challenge for the Bank of England. The MPC meets tomorrow and the press conference that follows it is expected to see Carney outline their plans for the rest of the year. This would naturally follow the precedent of the FOMC and the ECB giving advanced forward guidance. And the market seems to be getting cold feet around the prospect of an August rate hike. Sentiment is indeed growing that we may even see no further rate hike for the rest of the year. And if that support is removed from sterling, it could well be the catalyst for sterling dollar to test the 130 limits to the downside. We'll keep an eye on that for sure. Yesterday, Draghi reaffirmed his dovish monetary policy for the Eurozone, stating that interest rates are very unlikely or won't rise before September 2019. And indeed, if the Fed sticks to their rate hike agenda, the US rates are likely to be around 3% before the ECB hikes off their zero rate at the moment. That's quite a big interest rate differential that is on the horizon there. And indeed, yesterday we saw euro dollar fall to 115.30, which is close to its year low. Trump, meanwhile, he's holding firm on the tariffs and the trade war. He wants China to open its borders to US imports, but it's like he didn't get the memo. You know, the USA has debased its manufacturing sector, so ultimately, what have they got to sell to China? Historically, China, of course, is happy to play the long game in situations like this. They can afford to wait out any storm, and indeed, in the short term, they're happy to introduce tariffs of their own. But if the dispute overflows to other areas of the US-China relationship, I think that's when the international community will, gain a little more concern over this. For now, though, it seems a long way off. But meanwhile, here's an interesting one for you. Economics 101 for Big Don over in the White House. Import tariffs are an inflationary factor. Adding inflation to the US will reinforce the Fed's rate hike policy. In turn, higher interest rates in the US will lead to a stronger dollar. And a stronger dollar, that makes US exports more expensive for the international markets, like, I don't know, maybe China? So walk me through those objectives that you're lining out for these trade tariffs once more, Donald. I'm a little bit lost on your logic. Anyway, the dollar index rallied yesterday. We saw 95.20 tested. That's the big resistance at the moment, but it fell down to close around the 95 figure. We'll keep you posted. I'll talk to you again tomorrow.